conversation, and we are looking forward to questions as well from the audience, so that I think that was one of the key feedbacks from yesterday that I heard from some people, that more question time, let's get deeper. So we're hoping that we'll be able to do that in this session as well. But to kick us off, Lawrence, let me start with you. What are you seeing as the investment trends in carbon projects in Africa?
Okay. Morning, everyone. I think what we're seeing is we're seeing a market growing up. So, I mean, I'm looking at it from a banker's perspective. I'm looking to see how these projects are financed. And a large proportion of projects have, in the recent past, and the carbon markets are a very new market. So we're talking, in the last few years, we've seen projects financed very much on an equity basis, and whether that's direct equity coming in from project developers who are finding funding in the form of equity, or if that is in the form of prepayments for carbon credits from the end users of the credits coming in and effectively prepaying for the carbon credits and financing the project, but ostensibly taking that project development risk and that development risk being priced into those prepayments. So those prepayment prices will be a significant discount to where those credits should be trading. So we've seen that sort of early stage investment coming in very much an equity, from a very much an equity perspective. And that carries on. And the commercial banks and other sort of debt providers have been very absent. But what we're seeing is we're seeing kind of that market evolving and different role players coming in and role players taking different roles and different risks. So an example would be increasing number of off-takers entering into long-term fixed-price off-take agreements where they're not paying up front. So that means they're not taking that development risk. So hopefully, those prices should be more market-related. And that mechanism is opening up the opportunity for other participants to come in, like a commercial bank. Because now we see a big tech or a big oil or somebody else coming in with a long-term fixed price offtake, and we can take a view on that future cash flow to fund. We're still learning how to take the implementation risks and trying to find the right partners to work with, like the end of this panel, to see who can help us take risks as a commercial bank. But I kind of view this as kind of an evolution as we sort of, of the market evolving, and you're getting different investors coming in, and also really interestingly, interest from the institutional investor market. So where pension funds and other institutional investors are waking up and seeing that there's an opportunity to invest in nature in an investable format. I'm hoping that that sort of morphs and gets bigger over time, but we're kind of seeing the market grow up. So this investment, we say what the investors coming in are much broader and taking different risks.
Thanks, Lawrence. And I think there's some key points there about different institutional or different stakeholders coming in, but also risks. And we'll unpack the risks in a second. But before we get there, there was one key point you raised about long-term, fixed-term offtake contracts, and pricing is quite key on that. And with that, Iswanda, can I come to you with a question on that? How do the fluctuating carbon credit prices actually affect bankability of projects? And how can we actually build on investor confidence?
Yeah, thanks a lot, Reshma. I think there are two things to note. One, I mean, prices have been low in the past and have increased, and now they might be on a downward trend, and they might go up again, right? So first of all, I think to think about carbon as just an asset class. Right? I mean, the more we view it as a normal asset class where there is fluctuation around it, the more you will have risk mitigation products out there. I think a lot of the work that's being done, along with the ISCO also, is just look at it as a financial product and how you finance risk and how you price risk in itself, right? So at least looking at that. It's nice that it's nature, it's carbon, all of that, but as Lawrence probably knows, a bank is a bank is a bank. Right, so the more it looks and feels like something that you would look and feel in a normal banking world, the better it is, right? I think that's one point. The second is what we're also seeing, and that comes to the de-risking question, right? There are initiatives out there, and we'll touch upon them a little bit later on. There are obviously the IFIs, my friend from the FDB is here, but what we're seeing in markets that have become a bit more developed, so if you're Brazil, Italy, and India, and China, you have normal banks, Itaú, Santander, that have massive carbon desks there that are, again, treating it as a product, right? So in a way, where our job comes in as maybe MDBs is essentially de-risk, but not finance the products. And we can talk about that a little bit more, but let me stop there because I know we're out of time.
Excellent, thank you. No, we'll definitely want to come back to that when we're looking at the financing models. But one of the other challenges that we hear a lot around financing is scalability. So we've already talked about, some touched on risk, we've talked about pricing, but project viability and scalability is something that we hear a lot as a challenge. Emma, given the Acorn project, maybe you can give us some insights in terms of how do we actually increase project viability and scalability as well?
Yeah, of course. Thank you for the question, and thanks for having us here. Maybe to give a bit of context how Acorn came to be. Rabobank is one of the largest players in agricultural finance globally, and so we depend on agricultural producers to be climate resilient and to have future harvests. And we saw that especially in the smallholder communities in sub-Saharan Africa, for example, there's a lot of pressure of climate change. And so for us, the challenge was to help these farmers become more climate resilient, while at the same time not being able to bank them because that's not within our risk appetite. So we started the Acorn program. And Acorn is a platform that connects smallholder farmers to the voluntary carbon market as a tool to invest in their climate resilience building. So for many smallholder farmers that are looking for means to invest in their farm to transition to an agroforestry system, which builds a lot of resilience in many cases, not all, and incidentally also sequesters carbon. There we saw a great opportunity for the voluntary carbon market to pay for the climate change mitigation that also leads to climate change adaptation. But smallholder farmers are not our direct clients, so we built the program in such a way that we have an umbrella certification system that allows for multiple smaller groups of farmers collected by a farmer cooperative or a SACCO here in Kenya, or maybe an NGO that is very active in the region, to connect the farmers to that platform. We organize all of the MRV, the certification, the verification. That's part of what we do as a bank. The local partner helps with the implementation of the agroforestry system, educating farmers on their new sort of practices. And so in that way, we split the labor between the local knowledge that is very much important when you want to implement any sort of nature-based project, and that scalability globally. The reason why we banked on the voluntary carbon market is because it's the first market that actually acknowledges the value of nature. And so we know that there's a lot more value to what we do, but that carbon sequestration, that at least was enough to finance these interventions. And so that scalability is a way for us to decimate the costs of MRV certification and verification. With only 10% of the revenue of each carbon credit sold, we can cover those costs. It's changing a little bit with a lot of extra overhead due to new policy implementation, but that also de-risks investing in new projects because the policy becomes much more clear. Yeah. So that's for scalability. I'll stop here.
Thanks, Emma. So one thing that you mentioned was risk appetite. And we're very lucky that we've got different types of organizations in this panel. So I'd actually like to ask an open question to the panel in terms of what do you see as the key risks from your organization's perspective. Maybe give us a bit of background in terms of your organization, how and your role within carbon, but then also from a risk appetite perspective, what are the key things that are acceptable or you can manage, and what are the things that you're currently finding that we need something else outside our institutions to actually help with that risking? I can see a lot of people in deep thought, so who would like to go first? Emma?
Yeah, I would actually like to go first. So it was already mentioned the project risk and the price risk, two different components to the risk. Having long-term offtake agreements does help, so we can finance against the long-term offtake agreement if we are very comfortable with the production risk being low. So it helps to have projects that have some model farms that have already shown the way that the trees grow in this area. But I think a much more important thing that helps us with our risk management is what an organization like the World Bank is doing with the MIGA product. For those who don't know, MIGA is an insurance product for companies that want to invest and that have a certain risk of regulation change. And so MIGA helps mitigate those risks by working with the governments to secure that the investments will be able to be earned back in the future. I'm simplifying tremendously, and I apologize. So if you want to correct, that would be very welcome. But MIGA allows us to invest a lot in smallholder farmers and in agroforestry systems, which are very expensive, because we earn back those investments through the voluntary carbon revenue, not through the agricultural revenue. That's all for the farmer. The voluntary carbon market revenue, that's how the investments are repaid. So if that is jeopardized by, let's say, very heavy taxes that are implemented after we've invested, or very unexpected cuts from the government, then we need some sort of help to make sure that we can recuperate those investments that are still going to the farmers themselves.
And since she passed the baton, I think part of, from the World Bank side, is about policy consistency. I think we feel you can maybe have a bad policy, but the private sector will price the bad policy, and you might have a good policy, and the private sector will price that policy. But if you keep changing policy, that's hard to price. Yeah. So part of what actually MIGA does is essentially ensures policy consistency, and if there's a tax that's raised, that was mentioned, or maybe there is a legislation that gets passed, MIGA will protect against it. So that's on looping in the private sector. The other part is, I'll give an example. In Kenya, for example, right now, along with the government, we're setting up a green investment fund that provides financing for enterprises that want to access carbon markets. There's unpredictability. Obviously, they can invest and maybe they will not get the pricing that they want. So it's sort of a private equity fund that co-invests with them. So essentially looking at similar that you would look at a financial product, an SME guarantee fund and a carbon market guarantee fund, right? So that's another place right there. The other, I think, is looking at the regulation side of things, not from a, let's say, a MIGA guarantee perspective, but essentially, when we do our policy dialogue, I know Kenya recently passed carbon legislation. A lot of people in this room probably had feedback on it. Similar to Rwanda also, they had passed a carbon regulation. So we feed them into our policy dialogue. So what that does is if something is financed through a World Bank policy dialogue, the chances of reversibility are much lower because there is a financing that goes to the budget linked to it. Yeah. So what we try to do is once in a while have some sort of a carbon market initiative. Even the carbon market registry right now that's planned in Kenya is part of the next series of policy operations. And what that does is gives a way for the government to kind of have initiative that the private sector has commented on, the stakeholders have commented on, and then it's backed up by some financing support.
Any other thoughts on risk and carbon funds? I know you're smiling at me. See you.
Well, so I think we may just take a bit of a travel back in time and to ask ourselves, since this conversation is very specific to the African continent, why did we not succeed during the CDM era? In the Kyoto era, why did we not succeed? When I mean the continent. And a bit of numbers could help you put a context to this. The total projects in the pipeline and also in the portfolio of the CDM was over 4,000 projects. In the actual pipeline, there were about 1,800 projects, 1,800 projects, worth about $220 billion. Out of those 1,800 projects, there were only 33 projects in Africa. In fact, let's put it in context. Out of those 33 projects in Africa, only 16 of them were in South Africa. And now we are moving into another era, and we are talking about what do we need to do differently. One of the challenges then was, obviously, you hear the usual thing of lack of an enabling policy environment, but also there was a question of risk, perception of risk. And both from the financial side, how do you structure the investment needed to be able to jumpstart a project, and as well as finance the project all through the phases of methodology, verification, and those requirements. What I beginning to appreciate right now is we're now beginning to see the need to spread the risk and be very clear as well about what do we really refer to risk. Is a risk related to the design of high quality project, or is a risk related to the financing of project? So I don't want us to make the mistake to put risk in just one bucket and think it's just one thing. We need to be able to unpack it and be able to look into different layers as regards to the African continent. I'm happy to come back to talk about how we're looking at it from the AFDB side, but I just wanted to put that forward around, what have we learned from the Kyoto era as we move to the Paris era? What do we need to do differently when it comes to risk? What are those risks that are related to design, quality, capacity, and capability? And what kind of response systems do we need to have? What are those risks related to financing, and ultimately, issues about benefit sharing and the likes, and what kind of response do we need to have? Now, it comes down to the strength of the policy system as well. A policy system that is very clear on an incentive structure, a policy system that is very clear also on allocation of agency, and ultimately a policy system that is also very clear on a shared goal of what needs to be achieved.
No, definitely. Thank you for unpacking that. And I do want to come to the AFDB role. That the reason we actually focused on risk quite a bit in this session is because that's the first thing that you're told when anybody's looking at financing, and it's thrown out there as a big generic term without being understanding into its components, because there's certain elements that can, you have mechanisms behind it that can assist with the de-risking. There's certain mechanisms or elements of that risk that go into the pricing of the financing, and there's certain risks that means that the funders, investors will just walk away because of that. And that's why we're focused on this. So please do break it down to the next level in AFDB, because now we're really getting to the crunch of the discussion.
Great. So, and responding, and I think for me, it's always very important for us to appreciate the significance of policy as the biggest driver of shift. The biggest driver of change has to be. So, and I think the conversation yesterday was very much pushing for, and I like the fact that we have shared that a good policy framework is very important in the country. Mm-hmm. That is very clear on certain layers of how the market should look like, who are the players in the market, and ultimately what kind of projects are possible in that country. So our approach at the bank is to understand, first and foremost, what kind of markets are you looking at? Are you interested in 6.2? Are you interested in 6.4? Because different projects will probably have different layers of either risks, but also demands of what needs to be done. And that links to the financing needs for projects in different different types of projects. One thing that I believe is consistent across board is the need to de-risk investment. I think we all share that around this table, that is very fundamental. Then the question is, how do we do that? Now, the traditional response to that is the use of what we call blended finance. And I'm not a fan of that because we make it too simplistic. But there's a lot of innovation that is needed in that. So MDBs like us are able to provide, if not guarantees, we are able to provide extremely concessional finance that will be able to eventually crowd in private capital. You de-risk it to a certain level to be able to allow private capital to come in. We're doing that right now by creating a window we're doing within our Sustainable Energy Fund for Africa, CFA, where we are interested in a carbon program within clean cooking. Now, we have to be honest. Clean cooking as a vertical on its own may not be able to get investment. But if you combine clean cooking together with carbon credit, it may be considered to be it may present an appetite for the investors. So we're able to provide a blend of instrument, reimbursable grant, technical, pure grant. We're able to provide equities. We're able to provide guarantees for these businesses, and that can, where there is a shortfall in offtake agreement, you have these kind of resources and the bank sometimes will be willing to take a haircut should there be a loss, and that's the type of structure. Now, we are now moving into a phase where we are creating a dedicated facility. We call it the African Carbon Support Facility. And this facility is targeted at doing two things. Number one, we recognize that there has to be a support to the upstream. If you're going to have a downstream investment flows in project development, in generating high quality and high integrity carbon, you need a policy framework that is very facilitative of that. So we are providing technical assistance and grant resources of different sort to countries to be able to do some of the work that we talked about yesterday. If it's carbon registry, your beneficiary mechanism, and that is very significant. The bulk of the investment in this facility will go to downstream. Downstream are also to be able to blend that, use different instruments. Again, reimbursable grant, equity guarantees for projects to structure, offtake agreement, or to be able to meet transaction costs, or the verification costs, whatever needs to increase more project development on the ground. Many of you would know this. I think 70% of credits which are in the VCM coming from the African continent is coming from just 17 developers. In fact, some will argue a little more than 70%. And we need more. We need a critical mass of project developers on the ground. We need a critical mass of people who can develop high-quality projects, and Africans, non-Africans on the African continent, in order to be able to create a structured supply, as well as use our facility to negotiate, use our convening power together with the partners here to also create a structured demand. It is very important that we create an intersection of structured demand and structured supply. That can help us push for good pricing, but ultimately also push for good credit on the ground as well. Thank you.
Thanks, Alphonse. So I hear a number of things there. The kind of multiple income stream has come up twice, and the clean cooking example on the Acorn agriculture and credits. The number of projects, and this is really where the financing also needs to come into it. But before we come back to, I just want to take a slight turn onto technology. And Hania, the foundation has played a key role with respect to technology. Can you tell us a bit more about the enabling aspects of technology, especially with the financing in mind?
Yeah, thanks so much, Reshma. It's great to be here. So my name is Hania Othman. I'm part of the HBAR Foundation. Just to provide you a little bit of context, the HBAR Foundation has a sustainable impact fund, and we have been, since 2019, have been funding digital public goods for environmental asset markets in order to enable high integrity in these markets. And I think the main question that we're trying to answer here today is how do we finance sustainable projects in a way that every single organization and party trusts? So how do we do that? And in order for us to do that is to focus on enabling infrastructure pieces. Those enabling infrastructure pieces can be using technology in order to enable trust. And that's exactly where we come in, and what we have been working on since 2019 in terms of creating that enabling environment in a way that is accessible for everybody. So if you're thinking about what that looks like, that's a digital trust infrastructure. And so I'm here with my colleague, and we have been part of this ecosystem. We've been focusing on building out an infrastructure that is called The Guardian. And The Guardian, in essence, what it does, we have been focusing on digitizing policies, and methodologies. So we're talking about the rules that underpin this market. Everybody has spoken about it from their perspective. What we're doing is basically being an orchestrator and bringing those rules together in order to translate for everybody to understand that based upon one single data model and one single workflow. So we're bringing the market together in essence in order to create that trusted infrastructure. We've been working together with UNFCCC. We have digitized the 15 most used methodologies around there usable for Article 6.2. And currently have the largest digital public library of methodologies. So if we're bringing this back in terms of how does digital infrastructure actually enable trust in the market, it's about first understanding the rules that underpin the market, having those digitized in a single format, and then being able to build out applications and bringing together key ecosystem members in order to allow capital flows to link to direct actions. So that means that bringing it down to if a local community, for example, member has done a certain kind of action, that they will get paid back for that action, and that is able to be traced. And we have direct access to that information. We currently do not have that. So if we start thinking about what does an innovative structure actually look like, it's about, okay, how can we bring all these ecosystem members together, understand your requirements, and your requirements, and bringing those together into one singular workflow and having a form of real-time updates that are available onto that and connecting the capital flows to that. And that's exactly what we've been working on and what we have been enabling in the last couple of years. So one of the things that I would like to mention as well is one of our key members is called Alcad. Alcad has been developing a benefit sharing model. So Alcad is a large project developer. They have been developing a benefit sharing model because they've seen the need in the market in order to increase transparency to attract financing to their projects. This is the way that they're differentiating themselves from other project developers, is to allow for access in terms of understanding how does this actually trickle down to the local implementer. And how do they benefit actually from this? And they want to make that transparent and have that directly readable. So this is, I would like to focus on, okay, how can we bring digital technology in terms of enabling innovative infrastructure, financing infrastructure, and tying that together with all of the different requirements that all these parties have been setting.
Great. Thanks, Sanya. And I think with that, what we found whenever we've looked at projects is there's an element of transparency that is very much required, especially when it comes to benefit sharing and distribution. But there's also an element where we don't actually have the financing ability to distribute as well. So there's knowing, and then there's the ability to do that. So I think technology can play quite a key role in enabling all of those. But we've been talking at a very policy level, at a high level and side of things as well, which is very important in bringing the financing subject to life. But I'd like to go now into specific models that you have seen that are successful. And in these different financing models as well, if we can look at the different types of capital, so when we talk about private, public, blended, and some real kind of world examples of successful financing models, so that anybody sitting on that side can kind of say, well, okay, that's how I can tap into that specific one. Again, an open question to the panel. Lawrence.
I'll pick up to start. I think what we've seen, the key thing from a bank is don't do anything new. You know, make sure that what you're doing is analogous to something you've done before. So one of the deals we've done, we financed a carbon project. It was in clean cooking, and we just looked at it as project financing, and that model is working. A key element of that is making sure coming back to that price thing, a point where there was a credit-worthy off-taker with a off-take agreement with a fixed price up to a certain number of tons, and we could take a view. But then we had to look at the implementation risk, and then we just applied project financing models. We used the same mechanisms we use for financing renewable energy to finance a clean cooking project. And I think that's the secret, is just using the tools we have to do something new. but try and make it look as not new as possible. Because one thing a bank credit committee, and I imagine it's exactly the same down that end of the panel as is mine, they don't like new. They like to see we've done this before. So that was one way of doing it, just looking at it a pure project financing. But another project which hit the press a couple of months ago, which I think shows another direction, which is also something we are exploring and trying to make to work on, was from one of our competitors. Standard Chartered did a deal very recently with British Airways and a company called Curate, and Curate does enhanced rock weathering. And British Airways entered into a long-term offtake agreement with Curate to buy the carbon credits, and CFC, the insurers, stepped in and gave credit default insurance. And that meant that Standard Bank could fund without taking and having mitigated some of that project implementation risk. And I think from getting back to Reshma's point on risk, I can divide risk into three broad categories. There's price risk or market risk, which generally banks cannot take. And it doesn't matter whether it's carbon or coal or copper or whatever it is, we're not going to take a future view on the market. For as much as Fanjar said, I mean, markets are volatile. Banks are not going to take that risk. So we have to find a way to get rid of that, because banks are not going to do that. And then you've got that implementation risk, as in, will the project do what it says on the tin? Will it deliver the volume of carbon credits which, if paid for by the off-taker, would repay our debt? That's where banks can take some risk. But we're learning. And that's where we need sort of the insurance. We need MDBs and DFIs to help us, and that sort of element. And then there's the reputation risk. And that's where we're all sensitive about our brands. Our brands, we put huge amounts of money into our brands, and it's a huge part of our value. We cannot afford to have that tainted. So that's another very, very significant risk for any institution, and definitely for banks, that we've got to make sure we manage that. So when we look at sort of going back to what is good, it is doing something that is similar to something that the bank already does. And I think that Standard Chartered deal, where it's very simple, it's probably not very simple when you actually look at the documents, but the concept is simple. It's getting the right people to take the right risks. So the insurer could take a portfolio view that a bank couldn't. British Airways could take the price risk, which a bank couldn't, which meant the bank could deploy their balance sheet.
Excellent. Any other thoughts, Emma?
Yeah, I really like those examples. I was actually thinking about the Standard Chartered example. You beat me to it. Of course, there's also equity investors. And so depending on what type of project you run, you could work with an equity investor who takes all the risk on the market. But then the upside, in case the market actually improves, is not for the project developers, the people who do the work on the ground. And I'm thinking, of course, from private landowners, smallholder farmers who are day-to-day taking care of the trees on their land. So there is a choice that you can make if you really want to make that transition to, in my case, an agroforestry system, and you don't want to engage too much with the voluntary carbon market, you could go with equity investors. There's pros and cons, obviously. But I think a model that for Rabobank has been very interesting lately is debt for nature swaps. Because you see that in many countries where in our case, again, the agricultural example, where there's a very big need for climate adaptation finance, but the government doesn't have the financial space to do that because of high debt distress. A debt for nature swap can be a way to refinance outstanding debt, especially with an MDB like the African Development Bank being the guarantor, which drastically improves the credit rating, of that government, hence lowering the cost of capital. And all of the space that you create with that refinancing approach, money that would have otherwise gone to paying off debt at a higher risk rating, can now be funneled into a project in the country itself. And for the agricultural sector, especially when it comes to smallholder farmers, they often work in the liminal space between public and private land. And so larger projects with smallholder farmers close to forested areas can be very much benefiting from a swap system like that. And so we are still exploring, because to Rabobank it's a new product, but it has been done in the market, exactly like Lawrence said. That gives my colleagues and me a lot more confidence that it is a financially viable tool.
Also, I mean, just in addition to that, I think it's also possible, another model is to consider if you're looking at a large or regional program. Remember the days of Red Plus in the Congo Basin? So you could also set up a dedicated fund. And we did that, Congo Basin Forest Fund, about $200 million grant that was just available to support countries to be able to take some of those policy measures needed, some of those science-based, targets required in order to be able to, set the reference level, baseline, and all the necessary deforestation goals and targets, and ultimately then commit to reducing emissions from deforestation and forest degradation over time. Unfortunately, we know what happened to Red Plus. And so you can look at different models around, if you're looking at a large transboundary type of resource, you could create a dedicated fund that is available for both the public sector, but also for the private sector to be able to support that. Now, the traditional projects like renewable energy, MDBs are doing that all the time, But I also think there have been a missed opportunity. A lot of the projects that MDBs are financed, they could have qualified for carbon credit over years. I started thinking a lot about our portfolio over the last 10, 20 years. And I thought, wow, we've missed a lot of opportunity, even within AFDB, to link, to create. I'll give you an example. Was it Okaria 4 that was a project? One of the Okaria sites, the geothermal, was also CDM. Yes, I'm supported by the World Bank. And I thought, we did the Lake Turkana, 310 megawatts, and there was no carbon credit for that. So again, I think this conversation will also begin to help us understand what are the windows of opportunities to begin to link our traditional financing in a way that is consistent with potential carbon credit, which obviously will help the balance sheet of the project, but ultimately deliver more goods and results for the communities on the ground. Thank you.
Any other?
Maybe just quickly. Oh, sorry.
Go ahead. So I think also maybe how do we de-risk those kind of projects and attract more financing into East Africa or Africa in general is by increasing trust and understanding, having access to the data directly. And I think shining a light on areas that we previously it's very hard for us to find information on or to trace or to understand what's going on actually on the ground. So that's one of the things that we're working on and we're really excited about is exactly how do we shine light on these kind of areas and how do we access direct data instead of having reports year after or months after where we don't have access to the actual direct data. And this is where digital infrastructure also comes in. We're enabling digital infrastructure in order to empower not only the local communities but the financiers as well in terms of how they're allocating their capital and making sure that the ways that they're allocating the capital are actually having the goals that they're needing to have in order to continue that process.
And just shortly to add, I think because you have a title financing carbon projects, so I would maybe break it down into two things. For example, Banco do Brasil and Bindas, the Brazilian banks, they have a model similar to what was mentioned here, where they actually provide back end-to-end financing, but also go into the seller's market, find a buyer for large projects. Then you have normal projects that have carbon as an extra. And that's a completely different ballgame altogether. So you have an enterprise that's doing some normal business, and then the carbon is just a sweetener. And the way you would finance and look at the business models of these two is very, very different.
So there's a business model where the carbon is the sweetener, and then there is another business model where carbon plus, so the agricultural income or kind of clean cooking benefits. I'm going to ask the same question, but slightly twisted, and this is coming from my previous life, where I was sitting trying to convince my commercial guys in a financial institution to look at these projects. And the question I have is, if I'm a project developer, a technical person where I'm not a finance person, and then I've got these banks on the other side that are thinking traditional and are thinking, done this before, how do we bridge that gap? And how do we help more people be able for the banks to see that opportunity? Go on, Lawrence.
It's really tough for a bank to come in and finance a greenfield carbon project development. We have people approaching us constantly looking for debt for their projects, but they're not looking for debt, they're looking for equity. Because the project is not up and running. It's a great idea in principle, and they may even have that offtake agreement in place. But but it's really, really challenging for us to look at and be able to do those projects because we're effectively taking the equity risk. So, I mean, banks have a huge role to play in funding ecosystem preservation and ecosystem conservation in Africa, but we must stay in our lane and be commercial banks and provide debt. So I think the key formula is working out how to present something to a bank where you are playing into that and that you have the right backing so that there is equity and that there is a business case that's going to work. The banks can and must come to the party in taking some of the risk, some of that implementation risk, but we are not going to be able to take equity risk. And I think that's a key thing to bear in mind if you're a project developer approaching a bank looking for financing, you need to get your capital stack right. You need to make sure that the bank